Well, let's look at initial and continuing claims, shall we? We're expecting a number around 248,000 on initial. We bested that by a nice margin. 232,000. That is the smallest number going back to June 24th, so the last week in June. That is good news. And if we look at continuing claims, exactly as expected, Becky, 1,438,000, 1,438,000. How does that stack up? Well, 1,438,000 is roughly in line. The last couple of months have been 1,415,000. Prior to that, 1,434,000. So you can see we're bunching up right in that area. Now, non-farm productivity, second quarter final, minus 4.1. Minus 4.1. It was at minus 4.6, so that's an improvement. But I would tell you this, the first quarter of 22 was at minus 7.4. That was the worst since 1947, the second worst ever, because they started keeping records on productivity in 1947. Let's look at unit labor costs, the other side of the ledger, shall we? Expecting a number up around 10.5%. Also did a little better than our mid number. Our second quarter final ends up at 10.2%. 10.2%, not too bad, but we all know that productivity should not have a minus sign, and it's never nice to see double-digit unit labor costs. There's a lot of excuses out there about what productivity is doing. It's not calculated right. There's anomalies in the economy. Listen, traders don't want to be scientists or PhD mathematicians. They take it at face value, and it isn't looking pretty as of late. Becky, back to you.
All right, Rick, thank you. Let's bring in Steve Leisman with his reaction on all this, too. Steve, what do you think?
I think that the job market remains very resilient. You keep hearing these stories, and it's a really good example of, how to process some of these anecdotes. We hear stories of big companies either laying people off or stopping hiring. But it seems like when you have these low jobless claims, they won't pop. We hit a new level of in the 250 range, 240 to 250 range, and we haven't gone above it. And I think what's happening is we have had some shedding of jobs in places where perhaps there was overhiring in the pandemic. And what's happened is those folks maybe spend a bit of time in unemployment, but they seem to be finding jobs relatively quickly. On the productivity front, yeah, I get that traders don't want PhDs, don't want to look at it from a PhD standpoint, but it's a very complicated situation. We did have a surge in productivity at the early part of the pandemic. Now we brought back lower wage workers, lower productivity workers who had left the economy, and that's one thing that's driving down productivity right now. And I just would not step back. I know Jason Furman has sort of talked about the concern about productivity in the U.S. economy. I wouldn't be coming to conclusions until we sort of get this job situation situated here. Rick is 100% right about the unit labor costs. It's something that Fed Chair Powell watches. And just real quick, guys, before we go, take a look at the Fed funds outlook here. We are now pushing, I'll call it near 4%. I'll see what happens since the number here. But when we made the chart, it was 393. Now it's 394 for that peak rate now. Still see it coming down, but clearly, guys, Fed Chair Powell had a profound impact on the outlook for the markets with his speech on Friday. I think that was the impact he wanted to have, so I think he's sort of pleased, not necessarily with the market coming off, but with how the interest rate complex here has reacted to their seriousness about battling inflation. Becky?